Stuart says, I have a question on covered calls. We're looking at the Power Options screen. I'm sorry, the 14-day free trial. We just navigated over for illustrations. Is there anything we can do when a stock is down 15 to 25% as there's no money to be made then? What is your suggestion to people during downturns? Seems like there's more risk to selling 2 to 3 month out calls. Stuart, this is one of the reasons, and I don't mean to sound like a broken record, but I am, but this is one of the reasons why I greatly prefer using the married put or the collar structure on long stock positions. I know I have a floor in place. I know that I have a guaranteed limited risk that can't be violated like a stop order. Okay, if when you're going through earnings, especially now, you've got a 5% or a trailing stop on your position, and your stock gaps down 15 to 20% due to poor earnings announcements. You don't get stopped at the stop or the trailing stop. You get filled at whatever the market can give you, and that's that 20% loss. Okay. As I just mentioned with the covered calls, I'm not so much of a fan of continuing to roll down and roll down. What you want to do when you get into a new stock or a new covered call position, Stuart, is you want to set a floor for what loss you're willing to take. And I know everyone's afraid to do that. We tend to follow the Bill O'Neill rule that anytime we get into a stock position or anytime Ernie opens a cash secured naked put or a covered call position, he's going to follow the 7 to 8% rule, meaning if the stock falls 7 to 8%, he's going to look to adjust the position maybe, or just close the position and move on. It's not doing what he expected. There's other stocks in the market that are performing, that are stable, that are moving up. We don't want to risk the stock dropping 15 to 20%. If I'm only making 2 to 3% each month against it, that's putting me at a 7 to 5 month recovery rate, assuming the stock even stabilizes, and I can still get that 2 to 3% with the lower cost on the position. And the risk, of course, of selling calls below the stock price to get you locked into a loss if it does recover and recovers quickly. We, of course, have presentations on that as well. The selling the 2 to 3 month out, I agree. So what does he talk about? What is Stuart talking about? Well, naturally, I enter a covered call position. Let's just, we'll do it to be crass, I should say. Oops. Let's say that I got in the stock near that peak the other day. Let's put it at $28 per share. I know this is more of like a 50% loss on the position. But at the time, I was able to sell 14-day out September. Was it up at that price? I sold a 30 call, and it was probably worth a good premium of probably 2 to 210 if I got filled at those prices. All right, with the implied volatility. It would help if I selected that I sold this covered call, would it not? All right, so that's great. A potential 15.8% return with an out-of-the-money covered call. I did give myself almost 8% downside protection, not quite 10. We're probably at about 7 or 8%, meaning this is a 7 to 8% premium against the stock price. Stock could fall 7 to 8% before we start losing money on the position, Stuart. Now let's take a look. Let's add it to portfolio. Let's add it to August 19th. We're going to have our discussion for David after we get to Pierre's question. All right, the date doesn't matter. What are we down on my BBBY covered call? I'm down 59.5%. I know that's not the ranges you're talking about, Stuart, but this is just for an illustration. Could I even roll this down anywhere to see a potential profit? Most likely not. Let's take a look at our position actions and position analysis. The stock, of course, down 1103. It was at 12 when I looked last. Okay. All negative returns. Sorry for the scrolling. So this is the position analysis that you can link to in any position. Down below, the details of what my liquidation and future expiration are. We, of course, can see the rollout opportunities. I can mitigate some of this, but I'm still at a loss. Let me go down as far as I can into the various months and months and months out. Oh, there we go. Perfect. There they are. Well, not really. It's still based on being assigned, but okay. The first profitable positions appear in October. There we go. What do I mean by profitable? Well, it's speculation. I could buy to close my call for essentially nothing now, and I could sell on October 21st, 26th straight call for 307. Now, this would still get me a 4.3% return if assigned, dependent on what? Dependent on the stock being above 26 at expiration. All those lower strikes, we're still looking at losses of 21, 25%. This is 60 days out, but I need a 50% movement on the stock. Oh, I'm sorry. It's 100% movement on the stock again in order to get back to profitability. This is an extreme example. Let's go ahead and change our price a little bit. I'm going to leave the call premium, but we're going to change the price to about half of what it was so that maybe we can see some better ideas. But Stuart, the key is, that's right. If you let the stock go down 15 to 25% without hedging it with a put beforehand, not before the trade, but as the market started to turn, you might have wanted to consider buying a put to stop these kind of losses. Because once you get to that point where your stock's 20, 25% down, you know on average with a covered call, you're making 2 or 3% on the position. And how long is that going to take you to get back to break even? That's why we emphasize the put so much, or closing out of the position, Stuart, when it starts to hit those double-digit losses, 7 or 8% or 10% down. It's not doing what you want. You don't want to hold and hope in those scenarios. You want to try to get out of the position if possible. Let me edit this position. We're just going to say we only got 40 cents for this call because we bought the stock at 16. Okay? And let's see what rollout opportunities we may have available now. The stock's down to 15, so we're down still 31% or 32% in the entire position. Not quite close to the numbers you're talking about, Stuart, but closer than what we were looking at before. And in our position analysis view, our breakdown of where we stand right now, that loss of 32.8%, when the time value decays out of the option, I still can't believe there's 1.5% time, I'm sorry, 3.5% time value still remaining on that 30 strike call. That's unbelievable. All right. But we see here, we can mitigate some of the losses. Here's the 1450 call, just shorter term for 0.7% possibility. These are all speculative. The stock would need to be trading above those prices. Let's see if there's anything further down a few months out where you beat a reasonable strike price of 12, 13, 14 and have a profit. It's not too bad, actually. Going past the Septembers, I want to go to Octobers. Okay, that's not so bad, but it all still is speculative with this thing. And keep in mind, well, I'm in this, the Bed Bath & Beyond discussion, in addition for what we had on Mike A earlier. I'm sorry, I don't know if we'll be able to crop these two together. I did see another article that said Bed Bath & Beyond came out the other day and said they're not sure if they're going to have the capital available to pay their bills. So that's a whole nother concern. Anyway, Stuart, I apologize. We know we're down on this whole position about 32%. And we could roll out to the October 14, 2 months from now, and see a 6.1% return if the stock's trading above that. Now, in addition to Stuart's comments, what is the risks of doing this? Okay, the risks of doing this are multifold, naturally. The one risk is that the stock keeps going down and goes down to $5, $6 per share. We're going to compound more losses. This extra premium we're collecting here is not really helping us hedge against the position too much. It is about another 20%, of course, 17.6%. That's good. That's great. And if it goes up to 14, we could make 6%. But if it gaps back up above to 30, we're only going to be making 6%. And a lot can, like you said, a lot can happen between now and 2 months from now. So in general, the risks of going 2 months out in time in uncertain markets are exactly what you mentioned, Stuart. We don't know what's going to happen next. I could be giving up potential profit, but at this point, I have to tell you, 60 days from now, and Stuart added that he's holding this position for long term. But if this was my position, I'm down 33% now. I do this roll for a hope that it's not going to drop down to 5, that it's going to come back up slowly for some reason. I don't think Bed Bath & Beyond is. That's me personally. Take that with a grain of salt, folks. But in 63 days, if I make a 6.1% return, where 63 days before that, I was at a 32% loss, I am extraordinarily happy. I don't care if the stock went up to 40. I'm happy with that 6% because it's not a 32% loss. That's me personally, so I'll take that every day if that's a possibility. But as you mentioned, Stuart, going 60 days out, 90 days out, a lot can happen. You do want to try to roll for a credit if you're rolling up, because that's the other risk that might happen. You roll down to these lower strikes, the stock starts to move up, and you have to roll it, and you have to roll it, and you have to roll it. and you're adding more to the cost basis, but your plan is holding it long term. Hopefully you're collecting a dividend as well, so that's working in your favor. So again, as I mentioned before, let me just go here. Let me go to playlist, Stuart. And on our covered call ones, if you haven't watched these already, some more insight available. View full playlist here. Great. Sorry about that, folks. Let's see. Triggers for rolling a covered call. Criteria for the optimum time frame. I don't think you need that one. Rolling a covered call that goes against you. Here you go. Probably more insights and discussion with criteria there. And rolling out of the money covered calls. This one here, rolling a covered call that goes against you. I think that's the one you want to take a look at in that case for further insight than we've given today. And also triggers for rolling a covered call. Never hurts to review our thoughts on what triggers and when you'd look to make the first adjustment on a covered call that starts going against you. Always keep in mind, though, have a trading plan in place. Covered call, cash secured, naked put, bull put credit spread, bull call debit spread. If your stock starts to pull back 7, 8, 9% after you first got into it, you might want to consider just getting out of it. That is, as Stuart mentioned, if I'm using the approach we like to use of not being married to the stocks for a covered call return, selling slightly in the money covered calls for a higher probability of being assigned on the position. If I see it not doing what I want to, and it doesn't look like I'm going to be assigned, I might just exit the position and look for a better trade. It's not a long-term plan. Stuart, you are in a long-term holding plan. I get it. So that's what you're going to be looking for. And rolling the position is going to have those caveats, those pros and cons of rolling out 2 months or 3 months now that your position is down 15, 20, 25%. But if you're staying into it, it's still good to generate the premium. Try to knock down that risk, but you've got to watch the upside because you're probably selling calls that are way below your cost basis. You don't want to get trapped if the stock suddenly jumps up and you're risking getting signed early for a loss on the position. You can always buy back the stock, but then you're trying to cover the loss and make profit on the new position you just purchased. Okay, moving along to Pierre. He says, I would like to have your thoughts on the covered call ETF. I've been doing options for many years, but when your stock price is going below your cost basis, is it hard to generate income? Sorry, Pierre, I should have read this question with Stuart's. I apologize. So I think we've covered some of that. But yes, when the stock price is below your cost basis, you still might be able to generate 1, 2, or 3%. The at-the-money positions on your stock are going to have that premium on a normal stock of 1, 2, or 3%. But now ask yourself, what is the loss? Are you down 12%? Are you down 15%? How long would it take you to get back to break even just selling month by month or week, maybe week by week, but month by month covered calls, Pierre? You need to make up 10, 12, 15% on your position. Write cycles. Sometimes use that terminology in the calendar spreads. How many times do I have to write against the long call in my calendar spread to make up the cost for it, assuming I'm selling this just out of the money call that has this premium and I have 11 months to do it? Do I pay it off? That's sort of what you're evaluating now that your stock has fallen or your ETF has fallen. And you're trying to sell premium against it, Pierre. You know you're generating 1 or 2% per month or a little bit more. Okay. How long is it going to take you to get back to break even? Let me see where my loss is now. This is a married put. Oh, no, this is not. This is August 19th. We're going to get back to that in a moment for the other question that David sent in, the multiple questions that David sent in. AIG bought at 62.01. I did lower the cost basis to 57.96 with the income methods, and the stock's at 56.10 right now. But let's just take this value, 62.01, down 10%, 56. Let's say I started this as a covered call, and I had a little better cost basis here in this position. So I'm down 9%. Let's take a look at the custom spread tool. I'm sorry, 62. Yeah, we'll still use the cost basis of 62. I apologize. Okay. And I'm just going to take, I'm not going to use the weekly. I'm just going to use the standard monthly, Pierre. And the 57.50 calls at 95 cents. The stock's at about 56. Okay, so $1. That's about right. So what is our premium in this scenario? If the stock is at 56.10, okay, and we're getting $1 in premium, All right, so we're right about the wheelhouse, right? We're right at about 3% premium against the current stock price, $56. But I'm selling a 57.5 call, and my price is 62. I'm down $6. So this means it's going to take me 6 months to get back to break even, as the average just slightly out of the money, really at the money call, averages about $1 with the type of volatility the stock has. Now, is it worth it to stay in this position for 6 months? That's a question that you have to answer. Is it worth holding up the capital for 6 months to get this back to break even? What's my other issue now? You see this as a loss. Now, I'm at a bigger loss right now by not doing anything. But if the stock moves above 57.50, if we have, it goes up to 58 on Monday, and then it goes up to 59 on Tuesday, and then it goes up to 60 again, well, I'd only be $2 down, but here I'm at a loss essentially of $3.50. I've got to roll this call. I probably have to buy back this September call and maybe sell a November 60 or November 62.5 to try to get a small credit of 10 or 15 cents. And what's going to happen in that case? Well, now I'm in the position for another 90 days. I really only lowered my cost basis by 10 cents with the roll, not the dollar, because it cost me about $4 to buy it back, and I might only gotten $3 for the new call. So I might just be a little bit above that initial break even. Yes, I'm at a better strike now. I'm at the 60 or maybe the 62.50 strike in that case. And I might be looking at a profit, but it's going to be a very small profit, even getting assigned at 62.50, because I'd make the 50 cents, but I only got 10 cents extra. We're at about a 1% return, and I've been sitting on the position for 90 days now, plus whatever I started initially. So that's what makes it kind of hard depending on the loss that you've had. When the stock falls down, you're always going to lose more on the stock than you're going to be able to gain with the premiums back on the calls. And by rolling down and selling calls below your cost basis, you always run the risk of getting assigned at the higher strike price. At the lower strike price and getting locked into a loss, Pierre. That is a major risk on the position that you have to focus as well. And not to beat a dead horse here, but I thought there was one in here. I'll have to look for it. I thought I put it in the playlist, but I know I have a presentation somewhere of the risks of selling a call below your cost basis after a decline. We reviewed a few examples. It might have been done around March of 2020, to tell you the truth, when things started to recover, probably April of 2020, and then again, I think later on. I also know I did a presentation on the risks of selling calls below your cost basis to continue to make the trade there. In 2018, we had that disastrous 3 months at the end of 2018 with the decline in October, the volatility in November, and the straight decline in December that ended around December 26, 2018. I know I covered that topic then as well. And one last comment on all of this. Remember, as we discussed a little bit earlier, you're trying to manage with covered calls on a stock that is down, whether it's 15 to 25% in Stuart case, but he's looking to hold it long term and keep rolling it, or perhaps you're slightly less down in your case, Pierre, with the ETF that you're in, but you're still concerned about selling calls below because you know that you may be assigned for a loss in the position. As I mentioned before, never hurts to take a look at the stock repair tool to see if you can get back to break even faster. So we'll put in that $62 on AIG, put in the 100 shares. It's out to January. So this is a good example, a pretty good example. If that AIG thing we just looked at, I was looking at the 57.5 call, and I'm making a lot of assumptions. The stock won't go above 57.5 by September. It'll be real close to it, so the buyback cost won't be that much. I can still roll to the next slightly out of the money or at the money call and collect another dollar, and it would take me 6 months from today to get back to break even, so we'd be sitting in February, I believe. No, we'd be in March. I'm sorry, I apologize. We'd be in March. But here's a stock repair that gets me back to break even if the stock's trading at 57.40, and it's out to January. It's 2 months earlier than I would need than just selling the $1 strike and assuming I didn't have to keep rolling it and buying it back. Now, I don't know if this is going to give me a good profit if it's trading above the strikes. We'd be buying a 55 and selling two 57.50s, that ratio call stock repair structure. Yeah, it's only a 0.3% return if the stock is above 57.50. Still, though, $4.50 below my initial cost basis. I kind of like that. But I want to evaluate the two instead of just rolling the covered call month by month. worrying about getting assigned for a loss until it starts to move back up and I have to roll it a few times, then what I need to know now is a stock repair better? Is it going to get me what I want faster and a better strike price than continuing just to roll month by month by month by month with the covered call repair, Pierre? All right, so two different approaches there. Always check the stock repair before you commit to continuously rolling the covered call situation.